If you're looking for a case study in corporate surgery, well, you've definitely found it.
Oh, absolutely.
Today, we're diving deep into a major defining moment for Driven Brands Holdings, the automotive services giant, ticker DRVN. And this isn't just about, some quarterly adjustments. This is a fundamental multi-$100 million shift.
It really is. They're moving away from global complexity and just doubling down on North American specialization.
Exactly. So Driven Brands is actively selling off major assets to simplify its entire story, its entire investment thesis.
And this latest move, this is the final decisive step. They're shedding their entire international car wash division.
Wow.
I mean, this is less a restructuring and more of a radical transformation. They're trying to change what kind of company they are in the eyes of the market.
So our mission today is to give you a clear, jargon-friendly breakdown of this recent sale. We want to understand the motivations behind this strategic cleanup, and then analyze the financial health and, the future outlook for what's left, the core operations.
We've seen it time and again. The market just rewards clarity.
It does.
When you can define your core business and you strip away everything else, you often get a higher valuation. That's really the whole premise here.
Okay, let's jump right in. The big news that kicked this all off came in early December 2025.
Right.
Driven Brands confirmed the sale of its international car wash business, IMO Car Wash, to franchise equity partners, or FEP.
And this wasn't just some small piece of the pie. This was a huge international platform.
And the deal value?
It was big. It came in at 406 million euros, which is about $606 million US dollars.
And just to give you a sense of the footprint here, IMO Car Wash operates all across Europe and Australia.
We're talking about a portfolio that's like over 900 sites under the IMO and ARC brands, about 720 core locations.
And the service itself is key here. These aren't just, little mom-and-pop car washes.
No. These are high-volume conveyor wash services. They're often strategically placed in, high-traffic retail plazas and fuel forecourts.
So they require a lot of real estate, a lot of equipment investment.
Correct. And that capital intensity, that's the crucial point to remember when we talk about why they sold it.
And the timeline for this exit seems really fast.
Very decisive. The business gets classified as discontinued operations starting Q4 2025. And the whole transaction should close in the first quarter of 2026.
So why get rid of a functioning, market-leading international brand for $600 million?
Yeah.
I mean, we can look right at the company's stated goal.
Yeah, the CEO, Daniel Rivera, left no room for doubt. The message is very intentional.
What did he say?
The divestiture is designed to, and I'm quoting here, sharpen the focus on scaling Take 5 and driving consistent cash generation through franchise brands.
So what that really means is
Right.
they're removing these geographically dispersed operations.
Right, which require separate management teams, different regulations, currency risk, all of that.
To double down on North America.
And on their most reliable growth engine.
Okay, so let's place this in its proper context, because this is clearly part of a much bigger restructuring plan.
It's an art.
This is the second major car wash business they've sold in 2025 alone.
You have to see divestitures as strategic design tools. They're sort of the flip side of acquisitions.
Right.
Companies use them to prune away complexity and just focus their capital where it generates the highest return. And Driven Brands started this process earlier in the year.
By selling their U.S. car wash business.
Exactly.
Remind us of that first sale.
That was back in April 2025. They sold the U.S. segment to Express Wash Operations, which is known as Whistle Express Car Wash, for $385 million.
And that was the first big signal.
It was. The segment was immediately classified as discontinued operations. They had already begun simplifying their books and separating out the financials.
So by the end of Q1 2026, Driven Brands will have completely exited the car wash business, domestic and international.
In two separate massive deals.
Totaling nearly $1 billion.
I mean, that is a fundamental change to who they are as a company.
Truly. They're moving away from that capital-intensive corporate-owned model.
Think about it. Owning a car wash means owning expensive land, big machinery, managing water treatment. There's significant real estate leverage involved.
And the new focus, Take 5, is what?
It's an asset-light, franchised, quick lube model. A whole different ballgame.
And we can see that preference reinforced in how the leadership is now getting paid.
Precisely. The CEO's new employment agreement, updated in May 2025, it explicitly ties his annual bonus KPIs, his key performance indicators,
Right.
primarily to core metrics like adjusted EBITDA and revenue. They are tying executive pay directly to the profitability of the continuing businesses.
Which gives management every reason to make these divestitures clean and profitable.
Makes perfect sense, right?
It does. Now let's look at the buyer of IMO, Franchise Equity Partners. They just paid over $600 million for an asset-driven brands called Non-Core. What do they see in it?
They see a strong, defensible, market-leading asset. This is actually FEP's first international deal, and they're viewing it as a long-term play. Their strategy isn't to change everything, it's optimization.
Just make it run a little better.
Exactly. Increase wash volumes, leverage the existing retail partnerships, refine the customer experience. This just confirms that IMO is a healthy business. It just didn't fit DRVN's new mold.
Okay, let's pivot to the part that matters most for investors, the balance sheet, the financial fallout of these moves.
Right. This fundamentally cleans up their balance sheet and dramatically simplifies the investment story.
And the number one motivation is?
Debt reduction. The $606 million from the IMO sale is primarily earmarked for paying down corporate debt. This one transaction is projected to reduce their pro forma leverage by about 0.3x.
Okay, for our listeners who might not track leverage ratios every day, what does reducing leverage by 0.3x actually mean for the company?
It's all about risk and flexibility. Leverage is basically how much debt you have relative to your earnings. Driven Brands has a stated goal of getting to a 3x net leverage ratio by the end of 2026. Every tenth of a point matters. A 0.3x drop in one go is significant.
So it signals less risk to creditors.
Which can lower their future borrowing costs, and it frees up capital that was just being used to service that massive debt.
And this IMO sale is really the final step in a very aggressive debt management strategy they've been running all year.
Oh, far from their first move. We saw the sequencing clearly after the U.S. Car Wash sale.
Right.
They took those proceeds and immediately paid off their term loan facility, a $354 million repayment.
Why that loan first?
Because term loans often have higher rates or more restrictive rules. Getting rid of it gives them immediate freedom.
And they went even further to raise cash, didn't they? They sold a note they got from the buyer.
They did. They had a $130 million seller note, which is basically an IOU from Whistle Express Car Wash. They sold that on the secondary market for $113 million.
So they took a small discount.
To get the cash immediately. It just shows their priority was speed and liquidity to pay down debt.
We also need to mention the steps they took to stabilize their long-term debt.
Absolutely. In October 2025, they issued $500 million in new securitization senior notes at a very competitive fixed rate of 5.296%.
Okay, securitization can sound pretty technical. In simple terms, what does that do?
It's essentially taking reliable, predictable cash flows, like the royalty revenues from their franchise agreements, and using those as collateral for long-term fixed-rate debt.
So it takes away the risk of interest rates going up.
Exactly. It removes that risk from a big chunk of their obligations and provides a stable, long-term debt structure. The IMO sale is just the final piece of that puzzle.
Cool. Let's look at the actual performance of what's left, the continuing operations. What did Q3 2025 look like for them?
The results were strong. I mean, they benefited hugely from this cleanup. Net income from continuing operations saw a spectacular turnaround.
How spectacular.
We're talking $61 million in net income compared to an $11 million net loss in the same quarter last year.
Wow.
And consolidated adjusted EBITDA saw a solid increase too. It hit $136 million for the quarter.
So we know the whole story is about Take 5 now. Is that segment actually performing like the growth engine they claim it is?
Unquestionably. I mean, Take 5 is the jewel in the crown. It's the whole reason for this strategy shift.
So what were the numbers?
In Q3, Take 5's net revenue increased by a huge 14%. That's driven by two things. First, 6.8% same-store sales growth.
Meaning existing stores are doing more business.
Right. And second, just rapid physical expansion. They opened 85 net new company-operated stores.
And what about the margins? That's critical.
Outstanding. Take 5 reported a 35.0% adjusted EBITDA margin in Q3. This is what you call an asset-light, high-velocity business.
Very appealing to investors.
Extremely. It's recession-resilient and highly profitable.
But the picture isn't perfect. We have to talk about the franchise brands segment. Is that still acting as a drag?
It is. It's the necessary counterpoint to the Take 5 success story.
And what's in that segment again?
That's the legacy collision and more discretionary services like Mako and Meineke. And it's struggling. Year-to-date, same-store sales were actually down 1.2%.
Oof.
It signals persistent weakness, likely from consumers pulling back on high-cost repairs.
So if Take 5 is flying high at 35% margins, how concerning is this weakness in the franchise brands segment? I mean, are they just trading one problem for another?
That is the critical question. They are definitely trading a capital-heavy problem for a growth problem. The franchise brand segment is still a significant part of their business, and its slowdown directly impacted their overall sales guidance. It's like trying to drive a high-performance car with one of the brakes slightly dragging.
Management has to prove they can fix that.
Exactly. They have to prove they can rejuvenate those legacy brands while still prioritizing Take 5.
Okay, speaking of cleaning up the financials, there was this fascinating non-operational tailwind in Q3, a massive $37 million valuation allowance release.
It's a huge accounting cleanup, and it was tied directly to a regulatory change.
Right.
Basically, a new rule increased the company's ability to deduct interest expenses, which freed up a chunk of money they previously had reserved for future taxes.
So this $37 million, it wasn't from selling more oil changes.
Exactly. It's not operational cash flow. It's an accounting maneuver that signals better structural financial health. It's a non-recurring boost, but it definitely clarifies their balance sheet.
Okay, synthesis time. With the two big sales, the debt paydown, the strong Take 5, the franchise brands drag, what's the final updated guidance for fiscal year 2025?
For the continuing operations, they're projecting revenue between $1.85 and $1.87 billion. Adjusted EBITDA between $445 and $455 million.
And earnings per share.
Adjusted diluted EPS is forecast at $1.18 to $1.23. They did acknowledge that consolidated same-store sales growth would probably be a bit below their original range.
Because of the franchise brand's softness.
Right. But critically, the forecast for net new store growth is still very strong, 175 to 200 new locations, reinforcing that Take 5 expansion.
So this whole story boils down to a simpler, faster-growing, de-risked company, if you believe in the superiority of the quick lube model.
That is the new argument they're selling to the street.
Which brings us to our segment. This is not financial advice. Based on all this, it's the most plausible, high-conviction trade idea here.
Given this structural transformation, I'd pitch a relative value pair trade. It's designed to capture the valuation difference that simplicity creates.
Okay.
The trade is long-driven brands, DRVN, and short, a highly levered, diversified, capital-intensive auto maintenance competitor.
Long DRVN, short a structurally complex peer. Walk us through the rationale there.
Well, I think the market hasn't fully digested how big these moves really are. DRVN is now a structurally cleaner, de-risked company.
Right.
It's overwhelmingly focused on that recession-resilient, franchised, high-margin Take 5 model. They've executed 2 huge debt-reducing sales, and they're marching toward that 3x leverage goal.
And the short leg.
The short leg targets a peer that's still struggling with integration risks, or one that's burdened by big, underperforming corporate-owned assets, the exact model DRVN just got rid of.
So the thesis is simple.
Very. DRVN's focus on being asset-light and paying down debt will earn it a superior valuation multiple post-2026, compared to its more complex capital-heavy peers.
So the real value add here isn't just the cash, it's the clarity.
That's it. They've defined who they are.
Okay, so to recap the key takeaway for you, Driven Brands is pivoting decisively. They are no longer a global multi-service auto empire. They've streamlined into a North American franchise-centric asset-light model, capitalizing on the high growth and fantastic margins of Take 5.
And the final thought we want to leave you with is this. Consider the power of their newfound liquidity.
Okay.
They added 162 net new stores in the first 9 months of the year, mostly Take 5s. Now that the balance sheet is delevered by over $1 billion from asset sales, the excess cash flow provides massive fuel.
So the question is,
will this capital accelerate? Take 5's expansion even further, pushing their penetration into the North American market faster than anyone expects. That acceleration is the next big catalyst to watch.
a fascinating insight into a company fundamentally changing its spots. As always, remember that everything we've discussed here is purely for informational and discussion purposes. It is definitively not financial advice.
Do your own thorough homework before making any investment decisions. And we'll be back soon with another deep dive into the strategic shifts that matter most.